When your parents told you to buy life insurance, or when the topic came up at work or in a family conversation, did anyone actually tell you which kind? Term insurance, endowment, whole life, money back, ULIP? Or did they just say buy life insurance and leave the rest to you to figure out? And the most common confusion is between life versus term insurance. Here is the thing most people do not realize. Life insurance is not one product. It is an umbrella term for at least 5 completely different products that work in completely different ways, cost very different amounts, and suit very different financial situations. This confusion is something a lot of buyers run into, and it is why millions of Indians end up buying the wrong product, paying too much for protection they do not need, or worse, under-insuring the people who depend on them most. In this video, we are going to fix that. By the end, you will know exactly what term insurance is and what the other types of life insurance are, how the money works differently in each, and which one actually belongs in your financial plan. And the next time someone tells you to just buy life insurance, you will know exactly what to say back. Life insurance as a category refers to any contract between you and an insurer where the insurer agrees to pay a sum of money to your family or to you depending on certain conditions. The core promise is financial security. But what those conditions are and who the money ultimately goes to changes significantly depending on the type of plan you buy. There are 5 main types of life insurance available in India: term insurance, endowment plans, money back plans, whole life insurance, and unit linked insurance plans, commonly known as ULIPs. Some insurers also offer retirement or pension plans under the life insurance umbrella. Each of these products serves a different purpose. Some are built purely for protection, some combine protection with savings, some combine protection with investment, and the premium you pay, the benefit your family receives, and what happens to your money if you survive all depend entirely on which type you choose. The confusion happens because agents and family members often use the phrase life insurance to mean whichever product they are most familiar with or most incentivized to sell. Your job as a buyer is to understand the difference before you sign anything. Term insurance is the simplest and most affordable form of life insurance. It is a pure protection product, which means the entire premium you pay goes toward covering the risk of your death during the policy term. There is no savings component, no investment element, and no maturity benefit. Here is how it works. You choose a coverage amount called the sum assured and a policy term, typically anywhere from 10 to 40 years. You pay a fixed premium for that period. If you pass away during the term, your nominee receives the full sum assured as a death benefit. If you survive the term, the policy ends and you receive nothing back. Because term insurance is stripped of any savings or investment element, the premiums are significantly lower than any other type of life insurance for the same sum insured. A healthy 25-year-old can get 1 crore rupees of cover for a few hundred rupees a month. That kind of cover is simply not available at that price in any other life insurance product. Term insurance is designed for one purpose: to replace your income for your family if you are no longer around to earn it. Your home loan EMI, your children's school fees, your parents' medical expenses, all of these continue whether or not you are alive to pay for them. A term plan ensures your family does not have to face those obligations alone. The tax benefit is also worth noting. Premiums paid toward a term insurance plan are eligible for a deduction under Section 80C of the Income Tax Act, and the claim amount received by the nominee is generally tax-free under Section 10(10)(d), subject to prevailing tax laws. Now that you understand term insurance, let us look at what the other types of life insurance actually are, because this is where the real confusion begins. Endowment plans combine life insurance with a savings component. You pay a premium for a fixed term, and at the end of that term, if you survive, you receive a maturity benefit that includes the sum assured plus any bonuses declared by the insurer. If you pass away during the term, your nominee receives the death benefit. The premiums are higher than the term insurance because part of what you pay is being set aside as savings. Money back plans work similarly to endowment plans, but pay out a portion of the sum assured at regular intervals during the policy term rather than as a single lump sum at maturity. This suits people who want periodic payouts to meet planned expenses, like a child's education fees or for a wedding. Whole life insurance, as the name suggests, cover you for your entire life rather than a fixed term, typically up to 99 or 100 years of age. The premiums are significantly higher, and the plan accumulates a cash value over time that you can borrow against. The idea is that your family is guaranteed a payout no matter when you pass away. Unit-linked insurance plans, or ULIPs, combine life insurance with market-linked investment. A portion of your premium goes toward providing life cover, and the remaining portion is invested in funds of your choice, such as equity, debt, or balanced funds. The returns are not guaranteed and depend on market performance. Now that all 5 types are clear, let us put the most common comparison head to head: term insurance versus the other forms of life insurance. What are the actual differences that matter when you are deciding what to buy? The first difference is cost. Term insurance offers the highest cover at the lowest premium. The same 1 crore rupees of cover that costs about 500 to 600 rupees a month in term insurance would cost several times more in an endowment plan or whole life policy. This is because term insurance carries no savings or investment obligation for the insurer. The second difference is what you get back if you survive. With term insurance, nothing. With endowment, money back, whole life and ULIPs, some form of benefit is paid out at maturity or at intervals during the term. This is the feature that makes these products appealing, but it is also the reason their premiums are so much higher. The third difference is the purpose each product serves. Term insurance is built purely for protection. The other types are built for a combination of protection and either savings, investments, or wealth transfer. These are not the same goal, and they should not be funded by the same product without understanding that what you are paying for. Pause here and take a screenshot of this table. It is the clearest reference you will receive the next time someone tells you to simply buy life insurance without telling you which kind. Rather than giving you a blanket verdict, this is how to think about this based on your actual situation. If you are a salaried professional with a family, a home loan, and dependents who rely entirely on your income, term insurance could be where you start. It gives your family the highest possible financial safety net at the lowest cost. However, please do consult your financial advisor to determine the right plan for your needs. If you have already bought a term plan and are looking for a disciplined, long-term savings product with life cover built in, an endowment or money-back plan can serve a secondary purpose. But it should never replace a term plan. And the two goals, protection and savings, are better separated in most financial plans. If you are a long-term investor comfortable with market risk, already have adequate term cover, and want to build wealth over 15 to 20 years, a ULIP may be relevant. But treat it as an investment product with a life cover component, not as substitute for a term plan. If you are a high net worth individual looking to ensure a guaranteed inheritance for your family regardless of when you pass away, whole life insurance may have a role in your estate planning. But this is a specific use case, not a general recommendation. The common thread across all of these situations is this: term insurance is not one option among 5. It is the foundation. Every other product in the life insurance category is a layer you add on top once the foundation is in place. Whatever your situation, the starting point is the same. Make sure your family is protected first. ABSLI offers a range of term insurance plans designed for different life stages and income profiles. Check out the description box below to explore these. What is the difference between term insurance and life insurance in India? Life insurance is an umbrella term that covers several types of plans including term, endowment, money back, whole life and ULIPs. Term insurance is one type within that category and focuses purely on protection. It gives your family a lump sum payout if something happens to you during the policy term, with no savings or investment component attached. Why is life insurance important in India? Most Indian families depend on a single or primary income to cover everything from EMIs to education to daily expenses. Life insurance ensures that if that income stops unexpectedly, the family does not have to face those obligations alone. It is less about the individual and more about the people who depend on them. Which type is suitable for salaried person? For most salaried individuals with dependents and financial obligations like a home loan or children's education, a term plan is usually the starting point. It gives the highest cover at the most accessible premium, which means your family is protected without stretching your monthly budget. If this video helped you understand the difference between term and life insurance, share it with one person in your family who has been putting off this decision. Like and subscribe for more videos in this series. All product links are in the description below.